School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Presenting Block 1 Accounting and Overview. Unit 5 Cash Flow Statement.
After completing this unit, you should be able to understand the purpose and preparation of cash flow statement, distinguish between operating activities, investing activities, and financing activities, prepare the cash flow statement using the direct method, and prepare the cash flow statement using the indirect method. Introduction. The cash flow statement is one of the three most important financial statements. It shows the inflows and outflows of cash and cash equivalents over a period of time. The users of financial information give substantial importance to this statement as it acts as a tool to study the strength and long-term future outlook of the company. It also takes into account various activities of an enterprise. The cash flow statement of an enterprise provides information about the historical changes in cash and cash equivalents by classifying all cash flows derived from operating, investing, and financing activities. The revised accounting standard AS3 made it mandatory for all listed companies to prepare and present an annual cash flow statement along with other financial statements. This unit discusses and explains the method of preparing a cash flow statement for an accounting period. Features of a cash flow statement. Features of a cash flow statement are: number 1, a cash flow statement is a periodic statement. Number 2, it is a statement of change in the financial position on a cash basis. Number 3, it shows the movement of cash and explains the reasons for changes in cash position between two balance sheet dates. Number 4, it does not match cost against revenue. Number 5, it shows the inflow and outflow of cash and cash equivalents from various activities. Number 6, it helps assess the company's capability to generate cash and cash equivalents and channels to utilize those cash flows. And number 7, it provides information on inflow and outflow of cash and cash equivalents from various activities of a company under various heads, that is, operating, investing, and financing activities. Preparation of a cash flow statement. The basic documents or data required to prepare the statement are balance sheet, profit and loss account, and additional information. Objectives and benefits of cash flow statement. The objectives of the cash flow statement are: number 1, to make future financial policies. Number 2, to identify the extent of major expenses. Number 3, to devise the cash requirement for a period. Number 4, to find reasons for the net cash inflows or outflows. And number 5, to predict the financial strength of the company. The benefits of cash flow statement are: number 1, highlights liquidity position. Liquidity means one's ability to pay the obligation on time or as soon as it becomes due. A cash flow statement helps in determining the liquidity position of the business. It shows the cash position and gives an idea of the cash payments made in the course of business of the company, thus confirming the liquidity position of the same. Number 2, helps in cash management. A cash flow statement helps in the management of cash flow. With the help of cash flow statements, companies can estimate both future cash receipts and payments. With the help of this statement, it is easier for companies to make future plans related to cash without compromising on liquidity. Number 3. Maintain optimal cash balance. Another benefit of a cash flow statement is that it facilitates a company to maintain an optimal cash balance. It enables businesses to verify the possible idle, excess, or shortage of cash. After arranging for the required cash position, the companies can invest the excess cash or borrow funds in case of any deficit. Number 4. Comparability. A cash flow statement facilitates the accurate comparison of the cash-based performance of different companies as it uses the same accounting treatment for the same transactions and events. Companies can therefore adjust their cash flows as per the industry norms or modify them as per the structure of the industry leaders. Number 5. Indicates future. One of the significant benefits of the cash flow statement is that historical cash flow information is taken as an adequate indication of future cash flows. Past information on cash amount, their timing, and certainty of their arrival may be used for the forecasting of the future cash flows. It helps in confirming the accuracy of past assessments too. Cash and cash equivalents. As per Accounting Standard 3, cash comprises cash in hand and demand deposits with banks. Cash equivalents means short-term highly liquid investments that are readily convertible into known amounts of cash and subjected to an insignificant risk of changes in value. Cash equivalents have certain features. They are: Number 1. Cash equivalents can be readily converted into cash. Number 2. These are held to meet short-term cash requirements rather than for investments purposes. Number 3. Cash equivalents have a short-term maturity, normally 3 months or less. Number 4. Cash equivalents are highly liquid and easily sellable in the market. And number 5. Buyers of cash equivalents are easily accessible. Marketable securities and money market instruments are considered cash equivalents. Generally, it includes commercial paper, treasury bills, short-term government bonds, etc. with a maturity date of 3 months or less. Cash flows. A company creates value for the shareholders by generating positive cash flows for them. As per AS3, cash flows are inflows and outflows of cash and cash equivalents. That is, cash flows is the amount of cash and cash equivalents move in and out of a business. Cash flow generated in a company adds to its cash reserves, which further accelerate reinvestment in the company. Types of activities and cash flow classification. As per AS3, activities can be put into 3 categories. Number 1, operating activities. Number 2, investing activities. And number 3, financing activities. Cash from operating activities. Operating activities comprised of the primary activities of a company. These activities create the principal revenue stream for the company. Cash flow from operating activities is the first subdivision portrayed on a cash flow statement. Cash from operations is an indicator of the internal solvency of the company. Cash from operating activities signifies the cash a company generates from its ongoing and regular business activities. These activities include routine acts of manufacturing and selling goods or a service to clients. It focuses only on core business activities and does not include non-core long-term capital expenditures or investment revenues, etc. As it considers only the core business, cash flow from operating activities is a yardstick to verify the financial status of a company. There are two different methods to identify cash from operating activities. They are the direct method and the indirect method. The direct method tracks all cash transactions in a period and uses actual cash inflows and outflows. The indirect method begins with net income, then adds back non-cash items for cash basis figure. Cash inflows from operating activities. They include number 1, cash receipts from the sale of goods and the rendering of services. Number 2, cash receipts from royalties, fees, commissions and other revenues. Cash outflows from operating activities. They include number 1, cash payments to suppliers for goods and services. Number 2, cash payments to employees. Number 3, cash payment on behalf of the employees. Number 4, cash payments for insurance premiums and claims, annuities and other benefits. And number 5, cash payments or refunds of income taxes. Non-operating cash flows are clearly different from operating cash flows. For example, non-operating cash flows include taking a loan or issuing new shares and are usually non-recurring. Cash from investing activities. As per AS3, investing activities are the acquisition and disposal of long-term assets and other investments not included in cash equivalents. Investing activities are related to the purchase and sale of long-term or fixed assets of a company. These assets include land and building, machinery, furniture, etc. These activities signify the extent to which expenditures are made for acquiring resources to generate future cash flows. Cash flows related to long-term investments are also known as investing activities. Cash inflows from investing activities. They include number 1, cash receipt from the disposal of fixed assets, including intangible assets. Number 2, cash receipts from the disposal of intangible assets. Number 3, cash receipt from the repayment of advances or loans made to third parties. Number 4, cash receipt from the disposal of shares, warrants or debt instruments of other enterprises other than receipts from those instruments considered as cash or cash equivalents or held for trading purposes. Number 5, interest received in cash from loans and advances. Number 6, dividend received from investments in other companies. And number 7, cash receipts from future contracts, forward contracts, option contracts, and swap contracts, except when the contracts are held for dealing or trading purposes or the receipts are classified as financing activities. Cash outflows from investing activities. They include number 1, cash payments to acquire fixed assets, including intangibles and capitalized research and development. Number 2, cash payments to acquire shares, warrants or debt instruments of other enterprises other than the instruments considered to be cash equivalents or held for trading purposes. Number 3, cash advances and loans made to a third party other than advances and loans made by a financial enterprise wherein it is operating activities. And number 4, cash payments for futures, forward, options and swap contracts except when the contracts are held for dealing or trading purposes or the payments are classified as financing activities. Cash from financing activities. As per AS3, financing activities are activities that result in changes in the size and composition of the owner's capital, including preference share capital in case of a company and borrowings of the enterprise. It is the part of a company's cash flow statement which shows the flows of cash used to fund the company, which shows the flows of cash used to fund the company that involve equity, debt and dividends. It provides an insight into a company's financial strength and its capital structure. These activities are related to long-term funds or capital as cash proceeds from issue of equity shares, debentures, bank loans, etc. Cash inflows from financing activities. They include number 1, cash proceeds from issuing shares or other similar instruments. Number 2, cash proceeds from issuing debentures, loans, bonds, and other short or long-term borrowings. Cash outflows from financing activities. They include number 1, cash repayments of amounts borrowed. Number 2, interest paid on loans, debentures, and advances. Number 3, dividends paid on equity and preference capital. Sometimes one transaction may fall into more than one different classification. For example, the purchase of shares is an operating activity for a share broker, while it is referred to as investing activity for another enterprise. Non-cash transactions. As per AS3, investing and financing transactions that do not require the use of cash or cash equivalents should be excluded from a cash flow statement. Examples of such transactions are acquisition of machinery by the issue of equity shares or redemption of debentures by the issue of equity shares. Cash flow from operating activities. Calculation of cash flow from operation is considered to be the most complex problem area while preparing the statement. As mentioned earlier, as per AS3, a company reports these cash flows either by direct or indirect method. Let's discuss these methods in detail. Direct method. Under this method, cash receipts and cash payments are arranged and presented in the cash flow statement. The difference between cash receipts and payments is the net cash flow from operating activities. The financial statement provides the summarized data for revenue and expenses. The accrual basis of revenue and expenses are to be converted to equivalent cash receipts and payments. Some examples of cash receipts and payments are: number 1, cash receipts from customers or debtors. Number 2, cash receipts of royalties, fees, commission, etc. Number 3, cash paid to suppliers. Number 4, cash paid for purchases. Number 5, cash paid for wages and salaries. And number 6, cash paid for various taxes, interest, etc. Cash receipt from customers or debtors. In a standard scenario, if a business is run on an only cash basis, the sales revenue in the income statement is as same as the cash collected from the customers. However, normally credit sales are also made. The uncollected amount is reflected by the closing balance of debtors. To calculate the cash received from debtors, the opening balance, that is, debtors or bills receivable, should be added to the amount of credit sales and the closing balance should be subtracted therefrom. Hence, cash collected from debtors can be calculated as cash collected from debtors equals to credit sales plus decrease in accounts receivable minus increase in accounts receivable. Cash paid to suppliers or purchases. For purchases, cash payments to suppliers consider the cost of goods sold from the profit and loss account and others from the balance sheet, etc. The calculation goes as purchases equals to cost of goods sold plus closing stock minus opening stock, or purchases equals to cost of goods sold plus increase in stock or minus decrease in stock, or cash paid to suppliers equals to purchases plus opening balance of creditors or bills payable minus closing balance of creditors or bills payable, or cash paid to suppliers equals to purchases plus decrease in accounts payable or minus increase in accounts payable. Cash paid to employees. The calculation for such cash payments is cash paid for wages and salaries equals to wages and salary expenses plus opening balance of outstanding wages and salaries minus closing balance of outstanding wages and salaries. Or cash paid for wages and salaries equals to wages and salaries expenses plus decrease in wages and salaries payable or minus increase in wages and salaries payable. There are certain points that you should keep in mind. They are: number 1, the sale of fixed assets and investments does not require any adjustment here. Number 2, bad debts, sales returns, purchases returns, discount allowed, discount received, etc. require adjustment. Number 3, items like depreciation, amortization of intangible assets like goodwill, debenture discount, preliminary expenses, premium on redemption of debentures and preference shares are ignored. And number 4, non-cash items are omitted from a statement of cash flows. Indirect method. In the indirect method, the net profit or loss forms the base to calculate net cash flow. Non-cash and non-operating charges put in the profit and loss account are added back, whereas non-cash and non-operating incomes are deducted to calculate operating profit. Adjustments are further needed in current assets and current liabilities to obtain net cash from operating activities. Now let's summarize the unit. The cash flow statement shows cash inflows and outflows and cash equivalents. Enterprises give substantial importance to this statement as it gives a tool to the users of financial information and make them aware of the sources and uses of cash and cash equivalents over a period of time. A cash flow statement is a periodic statement. It is a statement of change in the financial position on cash basis. It shows the cash movement and explains the reasons for changes in cash position between two balance sheet dates. It shows the inflow and outflow of cash and cash equivalents from various activities. It helps in the assessment of the company's capability to generate cash and cash equivalents and channels to utilize those cash flows. It provides information on inflow and outflow of cash and cash equivalents from various activities of a company under various heads, that is, operating, investing, and financing activities. Cash comprises cash in hand and demand deposits with banks. Cash equivalents means short-term, highly liquid investments that are readily convertible into known amounts of cash and are subjected to an insignificant risk of changes in value. Marketable securities and money market instruments are considered cash equivalents. Generally, it includes commercial paper, treasury bills, short-term government bonds, etc. with a maturity date of 3 months or less. These activities can be put into 3 categories: operating activities, investing activities, and financing activities. Operating activities are comprised of the primary or main activities of a company. These activities create the principal revenue stream for the company. There are 2 different methods to identify cash from operating activities: the indirect method and the direct method. Investing activities are the acquisition and disposal of long-term assets and other investments not included in cash equivalents. Investing activities are related to the purchase and sale of long-term or fixed assets of a company. Financing activities are activities that result in changes in the size and composition of the owner's capital, including preference share capital in case of a company and borrowings of the enterprise.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies, IGNOU. Voiceover by Harpreet Kaur. Edited by Savita. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.